Hi everyone, I'm Natasha Vernier, the CEO and co-founder of Cable, and I'm joined today by Conrad, who is the co-founder and managing partner of Klaros. Thank you so much for joining me today, Conrad.
No, it's my pleasure. Look forward to this.
We're going to be talking today about the compliance environment, some of the recent consent orders, and how to build a good compliance strategy and culture. So to kick us off, Conrad, how are banks currently managing compliance risk in your mind?
Well, let's be clear. There are lots of different kinds of banks, and there are many different approaches. The population of banks that I work with most closely, these days is they're smaller banks, and they're banks that are specifically engaged in banking as a service. And I would say in that particular population of banks, again, there are a variety of approaches, but a common theme is that they are all working very hard to stay abreast of a rising set of regulatory expectations. And it's a challenging situation for all of them. Even the ones that feel like they've got it under control are trying very hard to upgrade all the time because they know that the tide is rising. And they may not be in trouble today, but that doesn't mean they're not in risk of being in regulatory trouble tomorrow. So in terms of how they're managing it, I think they're all paying close attention. They're working hard to make sure they've got the talent they need. They're looking hard at technology, and particularly a lot of emerging AI technology to see what's available. One of the problems you have when you're a small bank in particular, dealing with a lot of regulatory expectations, you don't necessarily have the money to apply the solutions that you see at the really large banks. No bank with $5 billion in assets is going to go out and hire 20,000 people to review transactions manually. You've got to figure out solutions that are a little bit more nimble than that, and so there's a lot of appetite for looking at new technology. But it's very much it's a dynamic situation. The strategies are shifting because the regulatory requirements are shifting, and people are adjusting and are learning on the fly. It's an interesting space to work in right now.
Given, as you say, a lot of the banks that you work with, and really a lot of the banks in the banking as a space world, are some of those smaller banks, that probably in of itself provides an interesting compliance challenge because the sort of compliance requirements and the compliance programs that they would have had to have had in place for their own perhaps branch-based customer book is very, very different from that which they need to support a fintech or 10 fintechs.
Yeah, I think that's another really interesting theme you see in these banks. And to put it in context, there are a few banks that offer banking as a service that are kind of built for that purpose, but they're the exceptions. And most of the banks that are in this space have roots in community banking, and they have boards and management teams and risk management teams that are all rooted in community banking. And community banking is a wonderful business in many respects, but it doesn't look a lot like banking as a service. And so the experience that you accumulate in community banking doesn't necessarily translate very well. And so these banks need to go through a pretty significant organizational transformation in order to really understand the new set of risks that they're taking and be able to manage those appropriately.
Mm-hmm. I've spoken to a number of banks recently which have been bought by investment groups or have new owners who are keen to get into this space. And I expect that sort of top-down pressure from a new set of owners certainly makes the changes a little bit more urgent at those banks.
Yeah, well, I think that's certainly true, and when you have the new owners. But I would say a more general phenomenon right now is that all of these banks are subject to periodic regulatory examinations, and those examinations have become quite exacting. And lots of banks, I talk to CEOs of these banks, all the time, and it's not hard to find ones that'll say everything was great for years. We had a wonderful relationship, and then, gosh, this last exam or the one that's underway right now, completely different. Sometimes different personnel, sometimes the same personnel just being a lot more aggressive, but the character of the relationship has really shifted.
Yeah. What are some of the common gaps that you see existing in risk management approaches across these banks?
Well, there are gaps and there are gaps. There's lots of different levels. I would say, at the highest level, I think of there's risk management and there's risk governance, right? And both of them, I think, are areas that the regulators are paying a lot of attention to. It's hard to find an enforcement action in this space that doesn't single out the need for greater board oversight, greater board attention. I think implicit in a lot of them is the idea that the board needs more expertise than it has. So starting right at the top, board oversight, big deal and a common theme through a lot of these orders. Getting down to a more technical area, BSA AML compliance is certainly one that comes out in a large number of these orders. The majority of banks that are in banking as a service are more specifically in payments as a service. And that clearly implicates, the whole array of BSA AML compliance obligations. And, for a lot of these banks, that, what they have done historically is commercial real estate lending in their communities. And the kinds of risks that you take when you are supporting retail payments at scale, they're very different. And so many of the banks that got into this area didn't fully appreciate that. They probably knew about it to an extent, but they didn't have the kind of experience with it that made it visceral and made them really kind of focus on it until the regulators began to call it out. So that's another one that commonly comes up. We see a lot of UDAP issues as well. I think not as frequently as BSA AML compliance, but UDAP is a fairly common issue as well. And then for the banks that are on the lending side, there's clearly a fair amount of regulatory scrutiny to fair lending. Now, it's not. I will say, having worked with a lot of these banks, it's not obvious to me that those are in fact the three biggest risk areas. But I think one of the reasons that you see them is because there are existing exam procedures that allow examiners to come in and focus on BSA, on UDAP, on fair lending, and you don't have the same kinds of examination procedures that might allow them to focus on, say, reconciliation. But we know from the Synapse experience that is also an issue.
That's really interesting. You're absolutely right. In almost all of the orders this year related to banking as a service banks, board oversight, independent effectiveness testing, BSA AML, hot topic, and reconciliation mentioned very infrequently, but actually, as you say, that has been the cause of the biggest issue that we have seen in this space. So the fact that it's because there are no standard routes to sort of examine that area perhaps is why, as you say, and I think that's really interesting to think about. One thing I'm wanting to double click on is that board oversight piece. If we take a medium-sized community bank doing its branch-based banking and commercial real estate loans, how does the board oversight differ in that context to what is actually being expected of that same bank that now has one or two fintechs?
So let's digress a little bit into kind of how bank supervision works for different kinds of banks, right? So again, most of these banks have roots in community banking, and community banks, by both statute and regulation, are exempt from lots of the compliance requirements that kick in at greater asset sizes. And so, as a board, as a management team running a community bank, you don't have to do things that are standard and pretty well understood at larger banks. So 3 lines of defense is not a well understood discipline. A lot of these boards don't have risk committees. Many of these banks don't have chief risk officers. I've had a couple of clients where they've got, compliance managed by a committee of the board rather than a compliance officer. Those sorts of approaches are longstanding among community banks, and for the traditional business of community banking, they work pretty well. When one of those banks gets into banking as a service, the kinds of risks that it's taking, they shift dramatically. So in addition to kind of the risks that are specific to the kind of business that they're in, like BSA AML goes with payments risk, they're also taking a lot of operational risk. And there's operational complexity associated with supporting fintech partners. And it's different in kind and quantity from anything these banks have experience with. And so at the board level, you don't tend to see a lot of people. You often find people that are wonderful board members. They've got really good intentions. They know their communities. They're effective in sourcing business for the bank. They're good counselors to the CEO, but they don't understand these risks very well. And it's not their fault. It's the strategy has evolved. The supervision has shifted then in the last couple of years for a lot of these banks. The bank regulators are now saying, well, yeah, they're the size of community banks. They have roots in community banking, but they're not really doing community banking. These are a different kind of bank, and the regulators are right about that. And so they're applying a different supervisory paradigm, specifically a paradigm that's really adapted from the regional bank size. And they're saying to these banks, well, you should have 3 lines of defense. You should have a chief risk officer. You should have a board risk committee. You should have an enterprise risk management framework. And all of these things for many of these banks are are new, and it can seem kind of crazy when you first hear about them. And so it feels like a lot. The boards and the management teams alike are, I think, struggling not just with a new set of expectations, but with a set of expectations that's fairly foreign to their experience.
Thank you. You mentioned the consent orders that have come out for banking as a service banks. And you also said that actually your experience has been that the areas mentioned in those consent orders don't necessarily always equal the areas of highest risk in some of those community banks entering the banking as a service space. And so how should these banks who are new to the banking as a service space look at those consent orders and use them to understand how to become more safe, to pass those exams, to evade intense regulatory scrutiny?
Well, so there are different levels of answers to that. I think the first thing I would say about those consent orders, if you're in the business of offering banking as a service, if you are a bank in that business line, you should read these orders, because there are little nuggets of wisdom in there that likely apply to your bank. And it's always a little bit. I mean, I've been a banker reading the orders that are brought against my competitors, and there's always this little moment of gloating when this they got it and we didn't, right? But I think it's also important to read these orders with a strong sense of humility. Take your minute and gloat, but then after that, realize you've got an opportunity to learn something here that could have great value to you. And there are a lot of learnings in these orders. One of the interesting aspects of bank regulation in this country is that often policy is established first through enforcement actions, and then only much later gets incorporated into things like exam guidance or regulations and so forth. So if you watch these orders, if you pay attention to them as they come out, you can see regulatory thinking evolving, and each order kind of incorporates the current state of thinking. And pay attention to some of the things that maybe aren't specific to your business model, but like what's the order telling you about how regulators are thinking about the board's role, right? What's it telling you about how regulators are thinking about the need for independent, supervision or independent review, right? Those sorts of things are being worked out right now by regulators at each of these agencies, and those views are getting articulated in enforcement actions. But those enforcement actions are harbingers of policy to come.
We've talked a little bit about BSA AML, and it's certainly been sort of the prime area of focus across these consent orders. Within BSA and AML, what is the one area that you think is getting the most scrutiny, or that banks should pay the most attention to?
Well, there have been many different areas. I would say one that seems to come up a lot has to do with onboarding of fintech partners. And there's a common, not infrequently, the banks are getting tagged with really failure to diligence their partners appropriately, failure to understand the risks that those partners are taking and bringing to the bank. Customer onboarding is clearly a common area of concern. So that in general, the regulators are being pushed the banks are being pushed by their regulators to a much higher standard of diligence than many of them are accustomed to in the past.
Mm-hmm. Okay. And then outside of BSA AML, what is the area that you are seeing the regulators pay most attention to?
I would say probably, other than board governance, which is a theme that sort of cuts across all of it, I would say probably UDAP. But again, I think the problem from the regulatory standpoint is they're not really equipped to supervise banks like these. The regulatory framework is keyed to asset size and balance sheet risks, and these are banks that, by and large, earn their living by taking operational risk. And so I think the regulators have figured that out at this point, but the toolkit that they have isn't really well crafted for these sorts of banks. So they're applying the tools they have, BSA exam procedures and UDAP and so forth, to try and do the best they can. But I think what it tells us is the toolkit's going to evolve. You're going to see the emergence of policies and exam procedures from the regulators that are better tailored to these banks.
And we're starting to see some of that change, the regulatory guidance and some of the proposed rules that are coming out, the broker deposit rule proposal.
Absolutely.
How would that impact these banks?
The broker deposit rule in particular?
Yeah.
I think it's likely to have very large impacts. And I think one of the challenges that I think I have and anybody has in trying to answer that question honestly is that the data are so poor, right? But what we do know is that the deposits that many of these banks source through their fintech partners are frequently considered brokered, have been considered brokered in most of these banks for quite a while. And the new rules are going to be much more restrictive. I think the likelihood is we're going to see a lot of banks that are in this space significantly challenged to comply with the new rules. And it could have quite a chaotic effect on a lot of the banks and a lot of the fintech partners.
And it's interesting that the regulators, in trying to provide more guidance, trying to give themselves these new regulatory tools to be able to manage these changes better, are perhaps likely to bring more chaos, a little bit more confusion to the space before we get to that sort of later point of clarity and better compliance?
Yes, I mean, I think there's a range of views within the regulatory community, and I think some of the regulators are really coming at the whole banking as a service arena from the standpoint of deep concern and skepticism about whether the banking as a service model can even be made to work. I think other regulators are maybe equally concerned, but a little bit more of the view that we ought to be able to work through this. And I think that there is not, as far as I can tell, a lot of consensus at the highest levels of bank regulation. And so I think the broker deposit rules, at least to my eye, appear to reflect a particularly skeptical view of the possibilities of banking as a service. I think that's personally, I think that's regrettable. I think yes, there are complexities and risks here. I don't think they are complexities and risks that are beyond the ability of banks to manage. But I do worry that a regulatory overreaction could have a pretty serious deleterious effect on the entire banking as a service ecosystem.
Mm-hmm. Are there any other sort of major shifts or rules that you think might come because they are areas of particular interest to regulators right now?
So as I said earlier, I think one of the things that is differentiating about the banks that offer banking service, at least the ones that are significantly concentrated in that business, is that in contrast to traditional community banks, in contrast to the historic business of banking, these banks are making their money primarily through operational risk. They're not making it on spread; they're making it on fees. And as I said, I think when you start to think about that from a supervisory perspective, right now the regulators don't have good data that allow them to identify even who these banks are. So you don't have to check a box on your call report to say we offer banking as a service. I think the data, there will clearly be increased reporting requirements eventually for these banks. That the regulators need to have greater ability to figure out who's in this business and how the extent to which they're in it and the kinds of risks they're taking. When you think about how you might, from a policy perspective, deal with banks that present heightened operational risk, I think one of the things that has jumped out to me for a while is capital requirements, right? And so one of the reasons this business has been attractive to a lot of banks is because, in effect, you don't have to hold capital against operational risk the way you do against balance sheet risk. So there's a regulatory arbitrage or a capital regulation arbitrage that's baked into the business model from a bank perspective. And I think that causes a lot of banks to look at this and say, wow, really attractive returns, right? But that's because they're not having to hold capital against it. And I think the regulators are likely over time to try and figure out some ways of requiring banks to hold more capital. And you can see that, again, in some of the recent consent orders. You can see it to a much lesser extent because there haven't been a lot of regulatory approvals. And some of the approvals that the regulators have made of mergers and acquisitions or new charters.
Mm-hmm. Yeah, interesting. So changing topic a little bit, how do you see automation helping these banks manage their compliance, evade that intense regulatory scrutiny that is happening?
Well, I think for the most part, it's aspirational, right? I don't think that the automation that's out there right now is proving terrifically successful in keeping these banks out of the regulatory doghouse. But on the other hand, I think if you try and imagine a future, maybe 5 years from now, when we've worked through the current regulatory issues. The banks that are under enforcement actions have resolved their problems. The regulators have got a more settled view of how to run this business. And you ask yourself, like, what will these banks look like at that point in time, right? They're still going to be small. There's for statutory reasons, the business of banking as a service skews very heavily to banks under 10 billion. And so these are small banks. They are, I think, by assumption, taking a lot of operational risk. They're managing it at that point well to the satisfaction of their regulators. How are they doing it? Well, you can't solve that knot, or you can't untangle that knot just by throwing bodies at it, right? That's an expensive solution that's not going to work, and it won't produce good results. I think by hypothesis, these banks, if there are such banks, and I think there will be, they'll be solving the problem by using better technology. And, I think certainly at Klaros, but I suspect at a lot of these banks as well, I'm sure at Cable, you guys are paying close attention to, what's coming along in the way of generative AI and some of the new AI capabilities. I think many of them have got a great deal of potential to streamline some of the risk management concerns and to bring more consistent judgments and more consistent standards of quality to the risk decisioning that's going on at all of these banks today.
Yeah. There is certainly a lot of room for improvement in how alerts are handled. And that seems to be a prime area for AI companies like Greenlight, of course, helping to do that. And the area that Cable is most interested in, of course, is helping the banks have oversight of those fintechs. So sure. There's certainly a shift that we're seeing in the market of, it used to be the case even just a year ago, that the banks would have the fintechs do not only the CIP and the screening, but also the transaction monitoring. And we're seeing that transaction monitoring being brought now into the bank itself. And we're starting to hear screening being done in the bank itself. And so I do wonder if we will at some point also have CIP being done by the bank. And if you have that situation, then really the question of what a fintech is changes quite dramatically, I think.
Yes. Well, the fact that the regulators are pushing this stuff into the bank is not very surprising. I think the regulatory community has for a long time felt a lot more comfortable when banks are managing their own risks. And I think one of the regulatory ahas here is, by gosh, a lot of these banks have been too dependent on fintechs that we, the regulators, can't see and don't understand. That doesn't feel good. We're going to push these banks to bring risk management in-house. That absolutely is part of what's going on right now. I think we can be pretty confident that will continue. It presents a lot of challenges, particularly for larger and more established fintechs, right? So if you built your business at a time when that pressure from the regulators on your partner bank wasn't so intense, and now your bank is saying to you, well, we're going to bring that in-house, it feels like you're losing some control over your customer experience. And that's a very challenging dynamic. And we have clients on both sides of that issue trying to work that out in real time. I think, at the end of the day, the regulators probably win. But it may be a while, and I think there will be a fair amount of resistance from a number of the fintechs as we go through that process.
Yeah,
and for understandable reasons.
Yeah. So these banks that are going to be entering or have entered this space, and they are exploring these new technologies really for the first time, what are some of the considerations that these community banks have when looking at new pieces of technology?
I think one of the biggest problems, and this is a hard one, and I don't know what a good solution looks like, but for a lot of the community banks, they're not technologists, right? They don't have people at home who really understand technology well, let alone emerging technologies well. And so I think it's very difficult for them. They can read the papers the same way you and I can. They can read about all this great technology that's coming out. Most of them have got vendors of technology knocking on their doors regularly. They get the same junk emails I do. But actually making good choices when you don't have a lot of technological expertise yourself, and then figuring out how you integrate those choices into your existing tech stack, that's a really hard problem. And great technology talent doesn't run into these banks. It runs to very different industries. And so I think it's going to be a real challenge. And I haven't seen a lot of these banks come up with great solutions there. Most of them are too small to offer really attractive compensation packages that would allow them to get a great technologist to come on board. There have been a few cases of pretty great technologists that have acquired banks, which is another solution, but the regulators haven't been too keen on that either. So this, I think, is one of the biggest problems that I see in kind of getting from the current unstable regulatory situation to a more stable future.
Yeah, interesting. Okay, so my final question then is really, I suppose, two parts. For banks who are not in this space yet or entering this space, what do you think the longer term risks are for them of failing to proactively update or cultivate a more robust compliance culture? For the banking as a service banks, where do they go if they enter this space and they don't upgrade their compliance program and culture quickly enough? What happens to them? And then secondly, for the banks who are not entering this space, who are just community banks and want to stay in that market, what about them?
Well, those are two very different scenarios. And I think fortunately for the banks that are community banks and want to stay community banks, they're not under a great deal of regulatory pressure right now. Their biggest challenge is really just with their business model. And so over the course of my professional career, which is getting to be an unspeakably long time, something like 75% of all the community banks in America have gone out of business. Some of them have failed, some of them have been acquired, but they're no longer independent banks. And the reason for that is that in most communities, the business of community banking is only marginally profitable, and you cannot make market rates of return on the traditional business of community banking. Plenty of exceptions. That's a very broad brush comment, but it is nevertheless on average true. And so the real problem for community banks is just figuring out how to make money. And because that's the problem, that is also the reason that many of them go into banking as a service, right? It looks like an option, a strategic option for them. That's an area where, if you play your cards right, you can generate a lot of deposits quickly and cheaply, and then you can deploy them to make new investments that hopefully will improve the returns of your bank. And there have been examples of banks that have done that very well. And so those examples are well known among community bankers. And, if you're sitting out there as a community bank worried about your profitability, you're looking over your shoulder at those thinking, hey, maybe, they did it, maybe I could do it, right? So the temptation is always there. If you want to get into that business, though, your first category, right? If you want to be in banking as a service, I think the best advice I would give to any banker like that right now is have a really detailed plan, because your regulators are going to be all over you. The one thing you can be sure of is if you go down that path, you are taking a lot of regulatory risk. And the one thing you want to be able to show your regulators is, we may not have all the capabilities we need right now. There might be some things that we're not fully on top of, but we know what they are. And we have, plans to deal with them, and just give us some time to work it out. We are not stupid about this, right? But too many of the banks that have gotten into this space haven't really had plans. And the result of that is they get into this dynamic with their examiners where they're just always on their rear foot. They're not, the regulators can find an issue and it's like, yep, okay, we got that, we'll deal with it. But it's never that we know about that, we've got a plan to deal with it, don't worry. And so I think, good planning and then careful execution of that plan and doing it in a way that your board has good transparency, good visibility at all times, that won't necessarily keep you out of regulatory hot water, but it should turn the temperature down somewhat. And I think any bank going into this business today really ought to take the time to build a good plan and execute against it systematically.
Yeah. Turning banking into a reactive process, turning it into a proactive process, not a reactive process. Yeah, absolutely. Thank you so much, Conrad.
More strategic.
Yeah, absolutely. Thank you, Conrad. This was fantastic.
Well, I really enjoyed it. Thank you.